Now, this one's not so simple. When can I convert to a Roth? Remember the confusion about contributions with this phase out, right? How much can I convert? No, that doesn't apply. The phase outs don't apply. We also hear a lot of questions about, well, when can I convert to my Roth? You can at any time throughout the year convert to your Roth IRA. It's considered being converted as of January 1. You cannot do a previous year conversion. So technically, you have to do your Roth conversion by 12/31, December 31st of the year that you want that tax year to apply for. It's 2023. We only have a few more years before the end of the Tax Cuts and Jobs Act, and we only have a few more years beyond that to where we hit this point of no return, where we're going to see significant increases in tax rates. This 40 to 45% effective tax rate. That's why I don't think anyone should wait on this strategy as long as it works for you. But if you want a conversion to be in place and effective for 2023, you cannot wait until the tax filing deadline in 2024 like you can for a contribution. Other than just general world peace and everybody having everything they need, if there's one thing I could wish for Congress, it would be to allow us to do Roth conversions by this tax filing deadline, but they don't want us to do that. It would be better for them because more people would do more in Roth conversions once they have their capital gains assessed and their income assessed. They would feel more comfortable about doing more conversions. I'm convinced about that. But your filing deadline, or your conversion deadline is technically December 31st, but do not wait until December 31st because the people that hold our money, what we refer to as custodians, often have deadlines that are prior to December 31st. We've seen it as early as November 1st. So if you think that you want to get a Roth conversion done by 12/31, you better start thinking about it now. So we typically start our conversion process for end of year conversions by September 1. We just actually started we've been having conversations all year. Many people we convert throughout the year, but those who have to wait till the end of the year, we start having that conversation. We start having the plans drawn up September 1st. We had the conversations a long time ago. So when can I convert my Roth? It must be done by 12/31, but don't wait until 12/31. All right. Will I pay tax on my Roth conversion? Well, what do you think? Of course, yes, you are going to pay tax on that Roth conversion. Now, if you manage it where your conversion amount is below your standard deduction and you don't really pay tax on it, well, that's wonderful. But technically, yes, you're paying tax on that. And now the next question is, how much tax will I pay? Well, that depends. So let's go over to our handy dandy tax chart here. And again, you can download this tax chart by going to AttleboroWealth.com. I'm just going to pull that in and show it to you here. Excuse me one second. Oh boy. All right, give me a minute. There it is. Let me just share with you where you can grab this information. So you go to AttleboroWealth.com and you go to Education and Resources. Do this drop down and you'll go to the slot corner. So these are Ed Slot's charts that I use all the time. So I want to give Ed his credit, and you'll come up to a page that says the slot corner. There's some information about the Master Lead Advisor group that I'm part of. And then at the bottom of this is download free tax planning, and you can just download that material and use it for your benefit. All right. You can rewind that if you need to, but this is where I grab this tax chart, and this is for 2023. So how much tax will I pay? Well, this is how you determine. See these marginal tax rates here. You start at 10%. We're going to focus on married filing jointly, but I want you to focus. If you're a single filer, pay attention over here to the single rates. So from $0 to $22,000 in taxable income. So that's after any deductions you have. Even, that may be the standard deduction, and you can grab the standard deduction over here. If you're married filing jointly, that's $27,700. If you're a single filer, it's $13,850. Head of household to $20,800. That just means that if you have deductions that are not greater than that and via itemization, then at least you get the standard deduction. And if you're married, and over 65 or blind, you get another $1,500 per, and then single as $1,850. And if you're over 65 and blind, you get a little bit more. So let's just use these as your taxable amount. So let's just say you're a married couple, you make $127,700, then you would land right here, right? 22%. You would pay the first $22,000 at 10%, your second $22,001 to $89,450 at 12%, and then you would pay that last $11,000 at 22%. So you land somewhere in the middle of this 22% bracket. So the first thing you might say is, all right, well, I have $90,000 left to go to the top of the 22% bracket. You might also want to get aggressive in your allocations and say, if I push it to the top of the 24, I can take that all the way up to $364,000. So your answer might be, I want to convert, if you have $1 million, I want to convert $264,000. This is not a recommendation. This is an example. You might want to make this amount that you convert, $264,000, take you to the top of the 24% bracket. And then you might want to adjust it for the following year. So how much are you going to pay? How much tax are you going to pay? You're going to pay 22% on the difference of $100,000 to the $90,750. If you're married filing jointly, remember over here, the single filers are different. And then from the $190,751 to the $364,000 that's left in there, right? So that would be $164,200. Then you would pay 24% on that, just those dollars. So your blended rate would be between the 22 and 24%. So you might end up maybe at a 23% effective tax rate just on that conversion. But that's how you figure out how much tax you're going to pay. And you can see that you get to decide how much tax you're going to pay, because you might say, all right, I agree with that. I'm going to move $264,000. You might say, I'm only going to move $100,000 because I don't want to pay more than, or in this case, $96,000, because I don't want to pay more than 22%. That's your choice. And if that works for you to get that money transferred over time, this is taxable, tax deferred, this is tax-free or tax advantaged, then that's fine. You get to choose. The IRS doesn't say, well, if you're going to do a conversion, you must do this. You get to choose. So I hope that's helpful. So how much tax do I pay? It's different for everybody. It's different for every conversion. You got to do the calculation. When will I pay tax on my Roth conversion? Well, there's two different options fundamentally. The first is, and these are not in any benefit priority order, right? So is withholding. That is, if you're using the $100,000 example and you're going from tax deferred to tax free and it's $100,000, and let's say your blended tax rate is 20%, you can say, you know what? During that conversion process, I'm going to send $20,000 to the IRS via withholding. $80,000 is going to end up over here in the Roth IRA. I'll never pay tax on that money again. I'll never pay tax on any growth. I'm good with that, as long as you meet the 5-year rules. And this $20,000 goes right to the IRS. And any withholding is considered to be paid throughout the year, so you don't have a timing issue. The problem, of course, is that there's nothing wrong with withholding the amount of conversion. You have to gross up. I mean, you're going to have to take out more than you would have if you paid it out of pocket or out of savings. But we'll have to do a webinar on that one. How to calculate withholding. But you don't have to worry about the timing on it. It's done. And it's easy. A lot of people just feel comfort in this because they're used to that withholding from their paycheck. It just continues, just like when you get your paycheck and you earn $1,000 and the IRS, keeps $200 and you get the rest of it. That's withholding. The other is, that's the wrong one. So withholding. The other is you can pay the earnings, pay it from earnings. So I make $100,000 a year. I'm just going to pay that tax out of that, out of those earnings. Or maybe you make $500,000 a year and you can pay the tax on the earnings. I don't know. Or you can pay it out of the taxable bucket. So if you've got, $500,000 saved in your taxable bucket. So that's anything that's not an IRA, your mutual funds, stocks, individual bonds, money market, CDs, savings. And you say, you know what? I'm just going to pay that $20,000 from this taxable bucket. Well, that's fine too, but you certainly don't want to wait until the following. Say if you did a Roth conversion today, August 29th, 2023, you don't want to wait until April 15th or whatever the tax filing deadline is in 2024, because you're likely to receive a penalty by the IRS for waiting that long. What you're going to want to do is make an estimated tax payment or pay that tax payment the following quarter. So in this example, that would be September 15th. You'd want to make that tax payment just to make sure that you don't run afoul of the IRS on that tax payment. So timing is very important. This is why if you look at my video about developing your retirement team, I talk about you want to have a certified financial planner on your team, someone who specializes in this kind of work, tax efficient strategies, IRA distribution and retirement plan distribution strategies. You want a qualified CPA on your team to address questions like the one I just discussed about timing of tax payments. And then you want a good attorney. And folks, if you're in your 50s or above, you want that good attorney to be not only a state attorney, but an elder law attorney, in my opinion. So you can either do withholding or pay earnings from a taxable account. Next question here. Will my Roth conversion affect my ability to do Roth contributions? The answer is no. And I get this question several times a year. Many times it's from it's a response from, well, my accountant told me because I did this conversion, I can't do a contribution this year because now I'm above this. Remember, if you make too much money, and this is based on modified adjusted gross income, with an asterisk, if you make, let me erase this. Hang on. If you make what the IRS refers to as too much money, then you can't make a contribution. If you're married filing joint, then that's $218,000, $228,000. So you say, geez, I only made $60,000, but I converted $200,000 or $300,000. And now my accountant tells me I can't do a contribution because of this conversion. Well, your accountant is completely wrong. And I would suggest that you find a new accountant, because I had this, well, I've had it many times, but it was sometime this year. There was a person who said, my accountant just said he can't point to the rule that says, you might be right, but the accountant can't find the IRS rule that says that the Roth conversions are excluded from that calculation, because they are. Roth conversions do not count against the modified adjusted gross income calculation for Roth contributions. So let me just say that one more time. Roth conversions do not count in the calculation of modified adjusted gross income for Roth contributions. So you could convert $1 million a year and still make your contribution if your normal income falls below, without the conversions, falls below the phase-out levels. So, it wasn't just the one time, but I've heard people say, I can't point to anything in the IRS code. Well, this is, I put it here for us. It is 590A. Where'd it go? Where's my publication 590A. It's right there. So here's an excerpt from 590A. And it's really simple. So again, you can look this up, 590A, just search IRS 590A, and you'll see, enter your adjusted gross income from your 1040. This is a worksheet to determine, if you're triggering that phase out. Modified adjusted gross income for Roth IRA purposes. Enter your adjusted gross income from your 1040, et cetera, line 11. Enter any income resulting from the conversion of an IRA to a Roth IRA. So you put, 50,000 in here if that's your thing. So you put 200,000 in here. You might say, well, that's going to take me over. Now it says subtract line 2 from line 1. So that gives us the amount that you subtract this line 2 from line 1. Enter any traditional income deduction from, and then it continues. So, and up here in the this notification, you'll see it reads modified adjusted gross income. Your modified adjusted gross income for Roth IRA purposes is your adjusted gross income is shown on the return with some adjustments. Use worksheet 2.1, that's the one below, to determine your modified adjusted gross income. It goes on to give a caution. Don't subtract conversion income when figuring your other AGI-based phase-outs and taxable income, such as your deduction for medical and dental expenses. Subtract them from AGI only for the purposes of figuring out your modified adjusted gross income for Roth IRA purposes. So I don't know how to be any clearer. The IRS code is very clear. This publication walks you through. So don't get caught up in that. That's a really common question. The next one, and we're getting tight on time. Am I too old or too young? You might be. You might be. Less about being too old than it is too young. Because if you're, think about the firefighter. He's 47. Let's just say he doesn't have the ability to draw. He's got the ability to draw out of his retirement plan under age 59 and a half, and even under age 50 because of his circumstances where he works. But if you're 47 or 50 years old, let's just say, and you wanted to roll over your 401k because they don't allow Roth contributions, they don't allow Roth conversions, roll it into an IRA, and then start doing Roth conversions, you're probably restricted if you're still working there. If it's a previous employer, you can roll over your funds. You might be too young because of this 59 and a half rule. If you're over 59 and a half, most plans allow you to roll those funds into a traditional IRA, and then you can convert however you'd like into a Roth. But if you're under 59 and a half, it's much, much more challenging. Am I too old? Oh, by the way, and you also can't do withholding on, even if you have $1 million in your traditional IRA and you're under 59 and a half and you want to roll it into a Roth IRA. This is something I see people get jammed up on all the time. They say, well, I'll just do that withholding that you talked about. I'll send $20,000 to the IRS via withholding. Well, that's considered an early distribution, not the Roth conversion, but the withholding is considered an early distribution, and you'll be penalized 10% on the amount that you withheld for tax. That stinks. So you could be too young in that regard. Could you be too old? We like to say, and I believe this, that if you think you're going to be here another 10 years on this planet, it probably makes sense for you to consider Roth conversions, but it should be looked at for sure. So you have to do a comparison. We always do. When we're looking at bringing on a new client, we want to make sure that we're going to be impactful. So, and that all this work, this crazy, busy, detailed work about tax efficient planning is going to be impactful and make a difference in people's lives. So we like to do that side-by-side comparison you've heard me tell you about. And that's where we see sometimes millions of dollars of difference, often millions of dollars of difference in the impact of people's own lives and certainly the lives of their loved ones. I get this. What is my break even? I convert $100,000 from my traditional IRA to my Roth IRA. What is my break even? Your break even is zero. There is no break even point. You'd have to assume that you don't pay tax at all on those distributions from your traditional IRA. Your break even rate of return is absolutely zero when you convert to a Roth IRA. So I have a really detailed video about that. I'm not going to go through right now, but that's a good question and one I get, but it doesn't matter. There is no break-even point. Other considerations. It does drive up your modified adjusted gross income. So as I said, I'm talking about Roth conversions. They drive up your modified adjusted gross income. So there are many things that are affected by that. Not Roth contributions, as you just heard and learned, but your IRMA, income-related monthly adjustment amounts. If you are over 65 and receiving Medicare benefits, then you probably know all about IRMA. IRMA is really a phantom tax on your benefits. They they charge you an additional amount, which can be significant for your Medicare premiums if you earn over certain thresholds. So we should probably, I think I've done a webinar on that, but if not, we should do one. So I'm gonna asterisk that. Taxation on your Social Security. So that modified adjusted gross income during your conversion periods will cause likely your Social Security to be taxed. These are typically temporary, and we have We have calculators that show the value of doing, the Roth conversions, tax savings, the IRMA savings over time. Usually it works out when we share that, even though you pay more IRMA in the beginning of your conversion, that it works out in the end. Same with taxation on Social Security. And then you have other tax credits. So it could erase other tax credits. One we're watching out on now is your EV credits, electric vehicles. So you can get up to $7,500 off the purchase of an electronic vehicle. But if you make over certain thresholds, a modified adjusted gross income, then you don't get that. And certainly Roth conversions will trigger that. So, okay, that's a lot of information. You see, there's a lot of questions. It's 11:03. We went a little longer than usual, but I appreciate you holding on. I hope you all have a great week. Remember, there is no webinar next week. If you have questions, you want to reach out to us or schedule time, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you want to go to where those charts were, you can go to attleborowealth.com. We have lots of videos. If you want to watch our previous weekly webinars, you can go through there, explore some of the topics that we go through. And if you want to look at the financial 15s, if you have smaller periods of time, you don't want to sit through what now is more like an hour and 4-minute webinar, then you can look at the financial 15s that we've started to divide up into smaller segments of time, maybe 8 to 10 minutes, and you can find them on our YouTube channel. Just search Attleboro Wealth on our Attleboro Wealth Management on YouTube, and you'll find it. Folks, that's it for this week. Have a great holiday. Great Labor Day. Have a great rest of the week, and reach out to us if you need us. Take care.